Hello, welcome back for more capital budgeting. We're going to look at example 3, and this will just review some of the concepts we've talked about and build on them just a little bit. KMA International wants to install an espresso bar in place of several coffee vending machines in one of its stores. The company estimates the incremental annual revenues and expenses associated with the espresso bar would be. So we're given that sales are $100,000, variable expenses are $30,000, contribution margin is $70,000. We have insurance, salaries, and depreciation that total $50,000, and that leaves net operating income of $20,000 per year. Equipment for the espresso bar would cost $150,000 and have a 10-year life. The old vending machines could be sold now for a $10,000 salvage value. I have this highlighted in red because this is what we are adding, the cash flow that's a little bit different than the other examples. We're going to sell our old vending machines and put in espresso bar. So we'll use the money that we get from selling those old vending machines to help pay for the equipment. The company requires a payback period of 5 years or less on all investments. Calculate the payback period and simple rate of return. All right, so first we need to determine the net initial investment in the asset. And we know to buy the espresso bar, it's initially going to cost $150,000. But we're going to sell the old vending machines. So we're going to take the $10,000 we get from selling the old vending machines and reduce the cost of the new asset. This is sort of like if you were to sell your car today, you would use the money you get. If you sell it for $5,000, you'd put it toward your $25,000 new car. So our net investment is actually $140,000 rather than $150,000. Now we're going to use this number for any of the capital budgeting techniques that we would use. Now because we were given an income statement and we know net operating income is $20,000, we'll need to convert that to cash flow in order to do the payback period. Because remember, payback period, net present value, profitability index, and internal rate of return all base their calculations on cash flows rather than income. So the net operating income was given to be $20,000. If you look at that incremental income statement, you'll note that the only non-cash expense in there is depreciation. Depreciation expense was given to be $13,000, and since that was subtracted to get income and it does not require a cash outflow, we're going to add it back. This will give us net cash inflow of $33,000 per year for 10 years. Now we're ready to calculate the payback period. We're trying to find out how long does it take to get our $140,000 back. So we'll take our $140,000 net investment and divide by the $33,000 cash flow that we're going to receive each year for 10 years. So we calculate that it will take 4.242 years to get paid back. And remember, the company requires 5 years or less, so this investment does pass that test. We're also asked to calculate the accounting rate of return, or the simple rate of return if you prefer to call it that. And remember, this was the only capital budgeting technique that uses income instead of cash flow. So we're going to take the net operating income per year of $20,000 and we're going to divide by the net investment of $140,000. This will give us 14.29%. Now normally we would compare that to the minimum required. That was not given in the problem, so it's difficult to evaluate if it passes the test, but we can calculate that the accounting rate of return is 14.29%. All right, so that concludes this problem. And so really what this did is just demonstrated how do you handle the proceeds from selling an old asset when you buy a new one. And again, it's much like buying a car. You would take the proceeds from selling your old car and put it toward reducing the cost of your new car. So try some problems on your own and bring questions if you have them.